Welcome to Chapter 4 on Volatility Scaling. In the last chapter on momentum trading, we saw how to build a simple trading strategy using time series momentum. Now that we have a trading signal, we'll have some idea as to the position we should take, for example, whether we should be long or short a given futures contract. Volatility scaling is about managing the intraday volatility in financial markets in order to maximize the Sharpe ratio. We want to make positive returns every day, but we also want to make them in a consistent manner with a low level of risk. When markets are volatile, there's potential to make or lose more. For this reason, we scale our position by the volatility in the price so as to pick up a more stationary return with a higher Sharpe ratio. So volatility scaling is all about managing the risk at a given moment in time. So if our strategy says we should be long, but there's a lot of uncertainty in the market, then we probably want to scale down our position. So how do we compute this volatility and how is it measured? What we want is at the start of a day, a forecast for the volatility for that day. There are many ways to do this, but a very simple and robust estimator of the volatility is to take the EWMA of the square of the price returns. This gives us a weighted version of the variance, taking the most recent returns as being more important. So that'll tell us if there's been a lot of movement in the market in the last few days, it'll capture that. So here's how to compute the volatility. And we take an EWMA of the square of the return series, and then we take the square root of that. So to estimate the volatility on a given day, we use all the returns up to that day with the exponential decay managing the weight of each squared return. So if M of T is our daily trading signal on a given day T, we will trade equal to a position size position T equal to G times M of T divided by the volatility of T. Here G is some global gearing factor determined by the capital in the fund and the annualized volatility target. Let's run through an example of the momentum signal computed at the end of the last chapter. So I'm going to take the momentum signal we had at the end of the last chapter, and we're going to scale our position based on the volatility. So here I have the volatility plotted in the green line. I've scaled this up just to give you a better picture, but you have some volatility plotted in the green line. There is the signal, which is the momentum signal for our gold contract, which was this orange line. And what you see is by scaling the position by the momentum, we see that when the volatility is high, we're going to scale out of our position. So our position will be slightly less aggressive than what we had planned based on this volatility scaling. And so when there's a lot of action in the market, we don't want to be take as much risk. So we reduce our position when things are very quiet, like here at the end, there's very, very low volatility. And then we can increase our position to take on more risk. So we see this increased position. So that's a quick introduction to volatility scaling. Volatility scaling is essentially a way of recalibrating our position size so as to target a fixed amount of risk on every day. Well, thanks for listening. That's chapter 4.